So let's talk more broadly about the private equity industry, obviously in the spotlight recently for both good and some challenging reasons. What I've noticed, at least from my seat, is there are some firms that have navigated exceptionally well, whether it's as a DPI matter or being able to have that good relationship with the LPs, whereas some of the smaller firms or those that have not had recent success are going to find the challenges to be even greater ahead. How have you thought about that?
Our industry is maturing and it's consolidating. And the cottage industry of the small partnership that does one thing really well, it's getting tougher and tougher. Not to say that there aren't going to continue to be entrepreneurial firms out there that do operate very successfully at a smaller scale. That will continue because we are an entrepreneurial industry. But the lion's share of the capital raising is going to continue to gravitate towards the larger firms. And in fact, if you look at the consolidation in the last couple of years, more than 50% of the private equity capital being raised in the world is being raised by 10 firms.
Yeah.
There is a push by investors, by the limited partners in our industry, to have fewer relationships. In the early days, everyone was experimenting and having multiple, lots of GPs managing money for them in different parts of the markets or different geographies. And as that's developed, people either they don't have the bandwidth or they want to focus more and have fewer, larger relationships that are more strategic. One of the reasons they want larger relationships is because they also want to have more co-investments alongside their fund commitments. And having co-investments, there's a limited amount of bandwidth that you have as a limited partner to do co-investments. So you want to do them with fewer partners that you're comfortable with, familiar with, you're underwriting together. And it also just makes you a more important client of that GP. If you're a bigger LP, you're more likely to get more co-investment flows. On the return side, you're also seeing the importance of being diversified globally in terms of getting liquidity, in terms of getting performance through the cycle across sectors, in the ability to access talent that's required to drive some of these businesses, the insights, the technology investment. When I sit down, or when Per, our CEO, sits down with some of our biggest clients, they want to have a very broad discussion about strategically how we work together, not about this fund or this deal or that deal. And I think that's where the larger firms can really differentiate the value add to their clients.
Do you worry about the single strategy, monoline, smaller funds? How do you think about that as well?
It's going to be, I think, fund specific to some extent. It will largely be driven by performance. Distributions, I think, has been the key issue in the top of mind of investors over the last several years. Not every company is appealing to public markets at every point in time. Not everything we own is getting a strong reception. So I think it's this scale and depth and diversification of the portfolio that leads to more distributions, which helps your investors manage their own liquidity profile of their program, which ultimately helps them reinvest in your funds. And that is harder to match if you're, as you say, like a monoline, single product, single geography, smaller scale business. I think the other point there to touch on is just talent. And our industry is all about talent and retaining and building teams. And if you are a smaller firm that's having some of these performance issues or capital raising issues or liquidity issues in terms of distributions, it is harder to both retain and attract the kind of talent that you need to stay in the business.
Hard Lessons is an original series from Morgan Stanley. For the full episode and an extended audio version, visit morganstanley.com/hardlessons.